What's up investors, Snir is here. REITs are a great tool for the individual investor to invest in real estate. They have performed better than the stock market historically, and they allow for the individual investor to invest in real estate assets that he couldn't have otherwise, like commercial real estate, offices, or buying entire apartments for rent. On top of that, REITs are one of the best performing assets in an inflationary environment, and in the current environment of inflation, it might be a good edge. In this video, I will cover all the basics you need to know as an individual investor in REITs, what they are, how they performed historically, what are the considerations around taxes, and how they compare with direct investing in real estate. So let's begin. REIT is an abbreviation for Real Estate Investment Trust. As a trust, they allow you to invest in real estate collectively with other investors. And as a tool, REITs allow you many benefits to holding direct real estate, like for example, liquidity. You can sell and buy real estate in the market on a whim, but I will cover all the differences in the end of the video once you will have more context on what real estate is and all the caveats. To understand REITs, we need to understand the rules that define them. I will focus on the rules that define them in the US, but they are similar in other countries. The first rule is that REITs must have at least 75% of revenues coming from real estate, either by selling it, by renting it, or financing it, which is a great point to mention the two major REITs out there. First is the equity REIT, which we will focus on. The equity REIT holds real estate and gets its money by renting it to others. The second type is mortgage REIT, which holds the mortgages for real estate and earns its money by the interest payments on the mortgages that it gives others. The second rule is that REITs must pay at least 90% of its net income as dividends for its investors. This means that the yield on any real estate investment trust is necessarily high, but it also has meanings on funding and growth of the REITs, because most of the money is given back to the investors and not enough money is remain in the company for reinvestments. I will touch on that later in the video. Guys, I want to remind you that I have additional content for the individual investor in the description below, and if you enjoyed this video, please hit the like button as it helps me a lot to grow. And with that said, let's continue. Next, let's talk about dividends and taxes. REITs are famous as a tool for income because they have high yields and most of their net income are paid back to the investors. You can see high income in your account pretty much immediately. But there are some caveats regarding taxes, so let's cover them. First, REITs as an organization are exempt from the corporate taxes that other companies are obligated to pay. So the income coming from the rents of the real estate are coming all directly back to the company without paying any corporate taxes. So that's a benefit. But the downside is that most of the taxes are going back to you as an investor when you are paid the dividend from the REIT. When you are paid the dividend from a company, this dividend is taxed as a capital gains dividend, which is the lower amount of tax compared to the ordinary income tax. But when you are paid dividend from a REIT, some part of it are paid as an ordinary income, which can get much higher than the capital gains, depends on your stance. You can see now on the screen the historical breakdown of the taxes paid on REITs through the years. As you can see, you typically pay 75% of the taxes as ordinary income, which means that most of the taxes you pay for REITs dividends are in the higher level. The division here is pretty complicated, but the basic logic is that for the rent paid to you, you will pay ordinary income taxes, but if the REIT sells an asset, then the extra income from the asset appreciation will be taxed as capital gains. There are two major things to take from it for the individual investor. First, don't compare REIT dividends to company dividends. A 7% company dividend might be higher effectively than 8% dividend on a REIT because of the taxes. And the second point, as an individual investor, you can avoid most of the taxes if you use the right tool, like a 401k account or a Roth IRA account. So as always, it's deeply individual and you need to run the numbers yourself. But as an individual investor, you have many tools to avoid the taxes with this kind of accounts if you invest for the long term, which make REITs even more profitable for you as an individual investor. Now let's talk about REITs performance. In the long term, REITs performed much better than the stock market. Look at this rolling 10 years average return graph compared to the Russell 3000. REITs performed much better overall and they have been less volatile through this time. Now, if you are an investor with a longer time horizon, look at this graph for the 20-year average return. As you can see, as the time horizon gets longer, the outperformance of REITs compared to stocks are getting even clearer. Last graph I want to show you is compared to the S&P 500. Sometimes people prefer this comparison because they want to invest in an index fund with the S&P 500, but as you can see here, REITs also outperform the S&P 500. One other thing to mention when we talk about performance is that REITs have many types. What I showed you here is a collection of all the REITs compared to all of the market. But of course there are many types. You have REITs for residential and also for commercial and for hospitals or data centers or many other types, and each type performs differently to the other types. For example, residential REITs are considered safer than commercial REITs because commercial REITs are tied to the economic state, because usually stores have an agreement that they pay compared to what they earn, and in an economic downturn they will earn less or maybe even vacant the space completely. Another example is offices right now. With all the movement to work from home, offices might be more risky at the moment compared to residential. So every sector have its performance and its risk, and you need to consider that if you want to invest in a specific REIT that specializes on one type or one sector. The next thing to consider about REITs are their growth and funding sources. As REITs pay most of their net income as dividends, they have almost nothing left from operations to reinvest in the business. So this means that if a REIT wants to grow, they have to get funding from other places. It can either raise debt, which will inevitably make it riskier, or it can dilute the current holders by offering more shares to the public. This means that unlike companies, even if the management of the REIT is phenomenal and can achieve great returns, it can't reinvest its money back into the business and be tax efficient. It has to get the money from outside. If they choose the route of raising more debt, they will become more leveraged as a company. Leverage can be good for the returns if everything turns out great. But if they default on their debt, they will get into a very risky place. They can go bankrupt completely, but that's usually doesn't what happens. What will happen is that we will have to sell assets at a loss, and that means a complete loss for you as the REIT holder. The second option, to dilute the current holders, is only worth it for you if they can achieve returns higher than the appreciation of the REIT itself. Then it means that it took another money and got the pie larger for everyone. But if with this new money they achieve lower returns than the REIT itself returns as a whole, it means that you lose money as you're being diluted. You also need to consider that real estate as a whole is growing much slower than what you may be used to in high growth companies or things like that. Even though there are exceptions, like right after the 2008 crash where real estate grew at 10 to 20% a year, usually the growth is at the lower end, like 2 to 5% a year, depends where you are and what real estate you hold. But at large, the data tells us that REITs are a great investment against inflation and they grow their dividends consistently. Look at this graph you see right now. This is a comparison between the REIT growth of dividends to the consumer price index, which represents the inflation. As you can see, the dividends grow much faster than the inflation. So even in real terms, you will always grow your income using REITs, at least according to all the historical data we have. So now that you are more familiar with all the intricacies of REITs, let's compare everything to holding direct real estate and see what is working better for you as an individual investor. Of course, there are many caveats to everything, so you need to consider your own position to decide which is better for you. There is no definitive answer. At large, REITs' differences from buying real estate directly are derived from two reasons. The first thing is that REITs act as a stock traded in the stock market. And the second thing is that REITs act like a trust managed by others. So let's start. The first thing you need to consider is liquidity. REITs are much more liquid than real estate because they are traded in the stock market, so you can buy and sell your REIT holding on a whim whenever you want. While if you buy a home in the real world, it's usually a process that takes months and involves lawyers and regulations and due diligence, and it's it's much harder. Personally, I prefer the REITs because I'm not ready to make a commitment like buying a real home right now. I prefer to be able to sell on a whim if I see a better opportunity or if I see something else I want to invest in. But that's what's working for me. If you have the money and you prefer the silence of real estate holding, you can choose that. Next is taxes. This topic is complicated as I already described, but if you hold a REIT, you will pay high taxes on the dividend. But if you have an account like a Roth IRA or 401k, it might be more beneficial for you. While in direct real estate, you will always have tax benefits from the government, depend on where you live, but usually you will have tax benefits. The third thing is diversification. When you buy a REIT, you invest in many assets through the REIT. The REIT might hold thousands of homes or thousands of stores or thousands of offices, so you're not tying your entire money to one asset that might fail. You can even invest in an ETF of REITs, so you even more diversify that way. But if you buy direct real estate as an individual investor, usually it means that most of your money is tied up in one asset, and it might work out for some people. If you find a phenomenal opportunity, it doesn't matter that you don't diversify. If it's a really great opportunity and you did your due diligence, it's great to invest in it. Next is management. In REITs, you have professional management that is an expert in real estate. So they handle finding opportunities for you, as well as the maintenance of the assets and finding the tenants and handling everything with them. But on the negative side, you don't have any control. The managers control everything and you don't have a say in anything they do. While in buying direct real estate, it's the exact opposite. You have complete control on everything, but you also have to do everything yourself. You need to find the opportunities, and to understand in real estate really deep, you need to handle the tenants, you need to handle the lawyers, the regulations, the maintenance, everything is on you. Last thing is leverage. REITs can have leverage internally as they can raise debt, as I mentioned before, but that doesn't affect your leverage on the holding. When we talk about your leverage on the holding, REITs act like a stock in a stock market. So getting leverage on this is much riskier and harder. You will get higher premiums on your loan, especially as an individual investor when you try to leverage buying of REITs. And also, just like stock, you can get margin called because REITs are traded in the stock market and they can be volatile at times, so you are at a risk of the margin call. But when you buy direct real estate, it's normal to take mortgage. So it's normal to take very high leverage on the asset, and you will get very good interest rates on buying a home, which you will not get for investing in a REIT. And this leverage is usually much safer because your home will not be traded in the stock market, so you won't get margin call. As long as you can pay the mortgage, the asset will remain yours. Guys, that's it for today. I hope you enjoyed this video. If you want to see more content for the individual investor, click on the subscribe button, and also I will make a follow-up video on how to value a REIT, which a link should be in the description or right here to my side. And I hope to see you next time. Bye bye.